Good afternoon, folks. My name is Mike Zlatnik. I'm here joined by Ray Gonzalez. Hi, Ray.
Hey, Mike, how are you?
I'm doing well. Thank you. We are both co-managers of this project, Riverbend Management 11235 LLC. That's the offering entity. We'll chat a little bit about the project, Riverbend Apartments. The executive summary is we've already invested in this project, $3 million, and we are subsyndicating up to $2.5 million to the friends and family investors who are interested to participate. We believe it's a great project. We're diversifying. We love the project so much, we took a front position on it. At this point, we're backfilling. So it's 996 doors in Indianapolis, value-add project. And we'll get into the summary in a second. Disclaimer, just please read for full disclosure. This is not an offer to sell anything. If you're interested in the deal, please request private placement memorandum. That is the only offering document. The deal is obviously, it's got risks and it's got significant upside. So it has to be to accredited investors only. And let me continue again. Please read all the disclosures and consult with your CPA or and/or attorney professional. We are not providing any kind of advice, nor do we play one on TV. COVID disclaimer, we live in the age of COVID. There are a lot of risks associated with COVID. It's an additional set of risks. Please be aware and consider it before making any decisions. Consult with your professional. Ray, could you please take us through executive summary of the project?
Just a quick high-level summary, what we love about the deal, why we invested $3 million into this deal. We love the location. We love the sponsor, the track record of the sponsor, the professionalism of the sponsor. We love that we have multiple exit strategies, a great basis. We love the opportunity to purchase it because it was inefficiently managed by tenants in common ownership. We love that there's a value add upside and there's risk mitigated by it cash flowing during the operations and during the 3 years of renovation. Again, we love the experienced sponsor with scale in the Indianapolis market. He owns another property close to this one where he's already executed, is in the middle of executing a value add plan similar to Riverbend. So we love that he has scale and track record in this market. And the last thing we love about the deal is there's magnified depreciation benefits, which Mike is going to get more into.
Thank you, Ray. So let's talk a little bit about the deal. So again, this is this is for educational purposes, for informational purposes. If you're interested to invest, please request private placement memorandum. Riverbend Management 11235 LLC is offering this deal. This entity is a feeder fund manager. We have a feeder fund called Riverbend Investments 11235. That's the entity where investors will participate by acquiring Class B units. All the stuff is disclosed in the PPM. Please request PPM for formal. The executive summary is it's a value-add deal in Indianapolis, a very experienced sponsor, and based on sponsor assumptions, after all costs related to the feeder fund, the target IRR on this deal is 17.8% on a 5-year hold. The deal has cash flows from day one, and it starts with slightly below 4% during the value add phase and increases over a period of a few years to the value add into the 9+ range. And the distributions are on quarterly basis to the degree that the sponsor distributes to us. It's a Class B asset. It was constructed in the 80s, and it's in a Class A location. So we believe that execution of the value add strategy, renovation and improvement of the property will easily enable the sponsor to increase the rent. It's projected to start, the current average rent is below $800 a unit a month to over $1,000 easily per month upon completion of the value add strategy. Over 28% projected to increase, and that will enable significant value increase in the property through increased cash flows, increased NOI, and ultimately valuation. So there's an alignment of interest between all participants and the investors. So the sponsor is investing $1.9 million. We've invested $3 million. We're scaling it down between down to 500,000 at least, possibly more. And the waterfall within the feeder fund is 80/20. Again, consult the PPM for all the details. The project has unique accelerated depreciation driven by a segregation study, plus some expense constructions in the first couple of years. And it is projected based on the sponsor estimates and our conversation with the CPA who is doing a segregation study, that the first year depreciation that'll pass through to the Class B members, the folks who invest into this deal with us, to be approximately 2.4x to 2.7x, possibly even higher on the amount of money they invest. And they should be year 2 and year 3 depreciation. For example, if you invest $100,000 and you get at least 2.4x, you should receive at least 240,000 of passive loss in the form of depreciation coming through the K1. So who could use this? Well, if you're a real estate professional, you could offset passive allocation losses from a project like Riverbend against your ordinary income. It could reduce your tax liability. So you could write a $100,000 check, for example, into Riverbend deal and get a significant deduction that could reduce your tax liability to the IRS. Again, consult with your CPA. We don't give any advice, but we believe that's that to be true and accurate. The second scenario is an equivalent of a 1031 exchange. If you have an appreciated asset which you have sold this year or will sell, and have passive investment gains in the form of capital gains, you can offset those with passive allocation losses from this investment when you get your K1. Again, it's a strategy to do this instead of 1031. Please consult your CPA further. We believe it's a very attractive opportunity from this accelerated depreciation, but you need to speak with your professional to verify this and to make sure that it works for you, for your personal situation. The project has multiple exit strategies. Upon completion of the value add, there will be a refi option and there will be a sale option. It is also possible to do a refi first and then a sale at a later point. So all of those things make the project very attractive. Ray, any comments on this?
It's great, Mike. One of the things that'll lead us to the future slides is on the depreciation. One of the things, as well as Mike pointed out, is if you're not able to use it now, you can also carry it back and use it, or you can carry it forward. So if you plan on having some gains next year, or whether whether you're a real estate professional or not, or you have some taxes you paid in the past, you can use this depreciation to offset that. Again, consult with your tax CPA. And yet that's what they've told us is that you can carry it back and you can also carry it forward if you're not able to use all of it this year.
That's right. I think it has a up to 5-year carry back and a carry forward obviously benefits, which is very, very significant if you're planning to sell something and you can't use it immediately. But if you are in this position today, you can take advantage in this current year.
All right. And how we're able to get those depreciation benefits is because we have higher leverage allows for these higher returns, and also for us to take a larger part of this depreciation. So the way this deal is structured is there's a $66 million first and another $19 million for renovation reserve. That doesn't get released up front. That gets released as the sponsor does the work on the property, right? So it's on a draw schedule. So total debt, if you count that, that's $85 million, but initially it's just a 66. After that, and the equity side, there's $22 million in preferred equity and a seller carryback, which acts like equity for $5 million. So at acquisition, at purchase, we're just counting the $66 million plus the 22, the 5, and then the common equity. You have a total LTV about 85% LTV going in, right? So it's pretty high compared to other deals. And the benefit of that is we are actually able to, because only 15% of it, really 10% of this thing is participating in depreciation, we get an outsized depreciation. As the sponsor does the renovations, the LTV is going to come down. The 87% LTV represents if the sponsor put the $19 million into the property and didn't achieve any growth in rents on the property or didn't achieve any higher valuation, which is really, really, really conservative, it'd be 87% LTV. Once the renovation is done at a valuation of $145 million, which we feel is very conservative, is our base case at 74%. Our pro forma at $160 million is 67% LTV. So what you're seeing is the leverage and the risk are being cut down, reduced as a sponsor executes the value add plan. And one of the final things we love about the deal is the majority of the 19 million of this money is going directly into things that are going to grow revenue, the roofs, the paint on the exterior, the landscape. He's not going to go in there and do things that aren't going to really drive rent growth. And the rest of the money is going right to the interior of the units. And the renovations are done as the units turn. So this project will still cash flow, further reducing risk. And then the final thing that made this a great deal for me and Mike to jump in ourselves is this is an experienced sponsor with a great track record. He's got 11,000 units, over 800 million under management. He's realized 47%, of the investments that he's gone full cycle from cradle to grave. He's got a 47% IRR and a 2.4 multiple. So the other thing we love is he's got scale, the sponsor in the current market. He's got a little over 1,700 units total throughout his experience. And currently he's got 995 units, not counting this one in the city. And he's currently undergoing a similar renovation plan in the city. So he's got in-house project management, in-house property management. He's got a built-in team, and he's got infrastructure there to really jump on this. So far, much so that in the current 3 months that we've purchased this, he's already ahead of schedule on the renovations. And we're making great progress on this project.
Thank you, Ray. Just one quick commentary. All-in cost is slightly over 123 million with all the renovation and all the budgets and reserves. So the sponsor's projected exit at 160 valuation or refinancing, and a sensitivity study driven down to 145 to be conservative. So we're giving you a little bit of an idea that we've gone through our due diligence. We felt pretty good about these numbers, and the renovation dollars, even though we're counting it towards leverage, they don't get released until there's progress with renovation. So in many ways, the LTV, the real LTV, is that 74.8 based on a conservative back-end valuation. So we feel pretty comfortable about that. If you count the real 160 million, which is very, very realistic, then the valuation, the LTV drops to that 67.5, which is a great number.
All right, quickly, a little bit about me. I'm married, got a 4-year-old daughter, and we have a baby coming, so we're excited. I've been at this since 2005. I've done everything in the real estate business in terms of fixing and flipping, buying and holding, being an active operator, as well as general partner on the multifamily side. And now over time, we've shifted into more of the passive role. So we do more of the passive investing, whether it's hard money lending, joint ventures, and deals like this with Mike, where we find stable cash flow deals with upside. And then on the personal side, I like some hobbies, basketball. I like the lifestyle entrepreneurship, and just grateful to be here with you guys and offer value to you guys.
Thank you, Ray. A couple of words about me. I'm a CEO of TF Management Group. We have a team. We've been doing this since 2009. I have a great team behind me, and I was delighted to be partnering with Ray on this deal. He's a very experienced investor, and we clicked very well. That's why we partnered up on this deal. So we're looking forward to grow our relationship. Again, I'm a fund manager. We have TF Investment Fund 2, Tempo Opportunity Fund, Tempo Growth Fund, family of funds, and that's what I do. It's my passion. Love real estate. Married, 21 years, 4 kids and a cat. Cat is the 5th child, so hope you can appreciate that. Very proud of the kids. They're all doing great. And I'm a mathematician by education. Here's the contact information. If you see this message, again, we are going to put the message out to friends and family only. If you get to, and you know Ray, reach out to Ray. If you know me, reach out to me. You can schedule a call with me via bigmikecall.com, or just reach out to me by email or phone. If you're interested, we will get you PPM, and we can have a follow-up conversation. Appreciate your time and consideration. Ray, any other comments?
Just thank you. Thank you guys for the opportunity and listening.
Thank you kindly.